Amazon's reported financial results seemed to disappoint stock market investors. Still, I wanted to dig deeper in the company's latest quarterly results, as I always do, because of how important Amazon is to all economies and all segments of business around the world. The company is on pace to generate over $600 billion of annual revenue, surpassing Walmart potentially in annual revenue. So let's dig deeper. Let's take a look at what's going on with Amazon stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, Amazon reported revenue of $187.8 billion, which was up 10% from the same time last year. If it wasn't for some currency headwinds, the company's revenue would have been $700 million more. Operating income of $21.2 billion was up 61% year over year, and trailing 12-month free cash flow was up $700 million year over year. Now, the main reason why operating free cash flow was not up more than that is because the company is spending so much on capital expenditures. Roughly $25 billion it spent on capital expenditures in the most recent quarter. And that could be the primary reason why the stock price is down. Is not only did the company spend about $25 billion in the most recent quarter on capital expenditure, but it also said it was going to spend about that much every quarter over the next 4 quarters. In other words, it said it was going to spend about $100 billion on capital expenditures in 2025. That's more than Microsoft, which said it was going to spend $80 billion, more than Alphabet, which said it was going to spend $75 billion, more than Meta Platforms, which said it was going to spend $65 billion, all of which are huge increases from the prior year. And most of this money, according to Amazon, Microsoft, Alphabet, and Meta Platforms, most of that money is going to be allocated to data centers optimized for artificial intelligence. So if investors were concerned about NVIDIA specifically and its prospects in 2025, those fears should be put to rest. Now that I've evaluated all 4 of the big large cap tech companies that are NVIDIA's largest customers, and they all indicated huge increases in capital expenditures in 2025. According to these prospects, we don't need to be worried about NVIDIA's revenue and cash flow and profit in 2025. In 2026, still maybe, right? Still maybe, but not likely. 2027, okay, you can start to be a little concerned about a drop-off for NVIDIA in 2026 or 2027, but certainly you can feel reassured about 2025. You can be reassured about 2025 because the 4 largest customers just came out and reported results and said that they're going to increase spending significantly. So back to Amazon specifically. Their focus continues to be on expanding selection, lowering prices, and improving convenience to drive strong unit growth that outpaced revenue growth. People are buying more things on Amazon. People are buying more things on Amazon because there are more things to buy, and those things cost less. Also, they're delivered to your doorstep in a really short amount of time. So people are more often buying things online now, and specifically from Amazon, and they're taking market share away from brick and mortar retailers that continue to offer less and less in terms of customer value, right? These brick and mortar stores don't have the things you want all the time. They are priced more expensively in most cases. The help in terms of customer service is from bad to awful, depending on the store you go to. And so customers are asking, why should we go to these stores anymore? They don't make sense. And more often, people are going to places like Amazon, and then it's coming at the expense of brick and mortar retailers, which every quarter it seems more and more brick and mortar retailers come out and say that they're going bankrupt or they're closing stores, they're closing locations because they can't survive the way things are right now. They can't continue to stay in operation with as many locations. So this is all great news for Amazon. And I don't think this trend changes anytime soon. I don't think that outside of the biggest retailers like Walmart, Target, and Costco, and then specific niche retailers like Home Depot and Lowe's, other than maybe those five giants, I don't see how any brick and mortar retailer can compete with the likes of Amazon. It's just not a business model that makes sense anymore in the day and age where people are spending more time online and people are buying things online and they like the convenience of things delivered to their doorstep. So Amazon's selling partners made up 61% of items sold in 2024. That's also good news. That's the highest mix of third-party units. What this means is Amazon becomes more of a marketplace. It doesn't sell things, it doesn't own any inventory, it doesn't make things. It just is the marketplace that allows third-party sellers to list their items on the platform. And at the same time, because Amazon is so large in terms of customer visits, total customer count, customer transactions, annual revenue, I could go on in every way you want to measure. Amazon is one of the largest businesses in the world. And so when you're that large, you can exercise power against your partners. And these third-party partners that are selling on Amazon, Amazon, exercises power against them. Amazon says things like, if we find out that you're selling these products at a lower price somewhere else, you're going to get punished as a result. If we find out that you're not treating customers fairly and the quality of these items are not good, you're going to get punished as a result. And so that power that Amazon exercises over these third-party retailers makes the ecosystem that much stronger, because now customers can trust items purchased on Amazon that much more, because they know Amazon is exercising that power against the sellers, and customers can feel confident that they're not going to be mistreated by sellers who are trying to throw junk on there and get by selling junk and then ignoring customers that ask for refunds or returns, etc. They can't get away with that on Amazon. Right. So one of the bigger risks lately for Amazon has been companies like Temu and Alibaba, which have been selling items at lower price points, but it takes longer for delivery. And so Amazon launched its own version of that, Amazon Haul, for the US customers in Q4. Now, this is going to be an interesting category because the Trump administration in the United States is threatening to remove that loophole that companies like Temu and AliExpress have been taking advantage of to bring products into the US and under the $800 threshold and not have to pay taxes on that, import taxes. And so if that loophole is removed, then I think overall it will be a great thing for Amazon. Even though Amazon now has its own service of a similar magnitude, I think if that loophole is removed, overall Amazon will be better off. So that's something that Amazon stock investors should pay attention to as the Trump administration is making all of these changes. It's hard to follow with the change and pause and tariff and cancel and pause, etc. So I'm evaluating all those things, but there's so much movement right now. I'm waiting to see where things settle to actually come to a conclusion. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.